It was 2009, and I was in Seattle. I was taking my two youngest children to school, dropped them off, went across the street to the coffee shop to have coffee, which I did every day. When I walked in, I stood at the end of the line, and in front of me was a friend of mine I recognized. So I called his name out. I said, "Hey, Bill, good morning." He turned around, and with an enthusiastic smile on his face, he said, "Good morning, Ben." And I could tell he was happy. He was pleased. Now, I knew that Bill was a contractor. He built homes in Seattle. And it was September of 2009. I know what was happening. Contractors were going bankrupt just automatically. There was no homes to build. There were no buyers. There were all sellers and no buyers. And it was a horrible market for real estate sales and for construction. So I could tell he genuinely was a happy guy. And so I said, "How are you doing?" He said, "I'm doing fine." And I said, "Now you're a contractor in Seattle, and the market is horrible. I'm interested in how you're doing fine." He said, "Get your coffee, come over, and I'll tell you." So we sat down, and he told me the story. He said, "There's two parts to the story." He said, "The first part is go back 10 years. He said, "It was 1999. I'm building homes, and this young man worked for me. He came in with a piece of paper, and he said, 'Bill, I'm giving you my resignation. I'm going to quit.' He said, 'Well, why are you quitting?' He said, 'Well, because I found an easier way to make a buck.' And Bill said, 'Well, tell me about it. Maybe I want to do it.' And he said, 'Well, it's easy. You just borrow $50,000 and buy Microsoft stock with it, and you can't miss.' You see, the last 15 years, Microsoft stock had doubled. So this young man thought if he bought Microsoft stock, it was going to double. So Bill looked at him and he said, 'Are you sure?' The young man said, 'Yes, I'm sure.' So he took his resignation. The young man walked out, closed the door. Bill got on the phone with his stockbroker and said, 'Sell everything I own.' 'Why? Everyone wants to buy. Why are you selling?' He said, 'It's very simple. They just reeled in the last sucker.' I said, 'Bill, you're a smart man.' He said, 'Well, hang on. There's a second story. Go back 2 years to 2007. I'm still building homes. Another young man comes in, hands me his resignation, and says, 'I'm going to quit.' 'Why are you quitting?' 'Well, Bill, I'm going to get into your business. It's very easy. You just build a home, and you sell it, and you make $150,000. And you pretty much can't miss.' So Bill said, 'Are you sure?' He said, 'I'm sure.' The young man walks out. He goes home. Bill goes home that night. At dinner, he tells his wife, he said, 'I decided I'm going to sell my business.' 'Why are you going to sell the business?' 'They just reeled in the last sucker.' You see, the stock market goes up, and the economy goes up, and it goes down. It goes through these cycles. Sometimes the cycles are smaller, micro cycles, and sometimes they're longer term, more macro cycles. But the market has got to do this. This is the way capital markets work. They go up and they go down. Sometimes they go way up and sometimes they go way down. several years ago, I did research on this question. I looked it up to find out how many market crashes there were since 1800. From 1800 to present, there have been about 22 stock market crashes. A crash meaning a decline of 30% or more. That's 220 years, so on average, that's about one every 10 years. Some of those I noticed were closer together, some were further apart. But about once every 10 years on average, the market would go through this down cycle, which I would call a crash, meaning 30% or more. Now, I'm not equating it necessarily to the economy, although the economy usually is correlated, but I'm talking about the stock market. The key to successful investing is managing downside risk. The way I see it, it's fairly easy to make money in the stock market when the market is going up. You just put money in. It doesn't matter a lot about what you buy. You could buy indexes or stocks, and most all of them are going up. It's not that hard. The key to successful investing is managing downside risk. That is the hard part, and it is hard. It's not easy. So people have tried to figure out how to moderate that, how to compensate for that downside risk so that the average person can live with it. Because if you just buy stocks, it's a pretty rough ride. And so they've come up with the idea of what's called modern portfolio theory or asset allocation. And it's a concept that was developed by a man named Harry Markowitz in 1952. And he did not develop the theory for the purpose of managing money. He said that. He developed it to explain non-correlation. But business schools caught on to the idea, and then they started teaching it as if this was actually a way to manage money, even though he said it wasn't. Well, that has become commonplace, and now it's accepted as the norm for stock and bond portfolios to be designed in a way to moderate risk. That works, sort of. I don't think it works really very well in up markets, but it works well enough that most people will accept it. However, it is primarily designed to protect losses in stocks in a declining market. For the last 40 years, since the early 80s, bonds generally have been going up because generally interest rates have been on a decline from 18% or so down to zero. So if interest rates decline, that means bond yields decline. And if bond yields decline, that means bonds, generally speaking, go up. And they have gone up for the last 40 years. However, interest rates hit zero. So where do you think interest rates have to go from here? And where do you think bond yields have to go from here? There's only one way to go, and that's up. So, and what that means is there has been only one place for bonds to go, and that's down. Now that was obvious to me. I'm not an expert in that area, but it was pretty obvious to me. A year and a half ago, I've been saying this over and over and over for the last year and a half. Be careful, be careful. And this year, 2022, stocks declined. Why? They were overvalued. They were way overpriced. It didn't take much to send them down. You could say it was the war in Ukraine or the action expected by the Fed, which would probably ultimately crash the market, anticipation of that, whatever. There could be various reasons that we could assign to it. There was nothing that was extremely obvious, but there were a number of things behind the scenes that you could attribute to it. But the reality is stocks were overpriced and it didn't take much to send them down. We accept that. However, what was interesting was that bonds normally go the other way. They go up when stocks go down. But with interest rates at zero and the Fed on the move to move interest rates higher, bonds fell. I mean, they just collapsed this year. And in some cases, bonds dropped more than stocks. Crazy. And it caught investors and financial advisors by surprise. They didn't expect that. I saw an article this week from, it was quoting Bank of America, I guess their chief investment officer from Bank of America said, 2022 has the deepest decline in a stock bond, a 60-40 portfolio, the deepest decline since 1936. That's a long time. So people were not prepared for it, but that reality happened. And so protecting against downside risk is the key to successful investing. There are two major philosophies in protecting risk. One I just explained. The other is what we use. We use a tactical approach. We have a method to get out of the market when the market is in a period of decline. We have a mathematical method to do that. We don't get out the very first day, but we get out fairly soon. And we don't get back in the first day it goes back up, but we get back in fairly soon. So we have a way to detect risk entering the market. And so that's our approach. So we want to be invested as much as we can in a rising market. We want to be out of the market as much as we can in a falling market. So far, we've been successful at doing that. Now I want to talk about another story, which I covered several months ago. And this is the story of Joseph Kennedy. He's pictured here in the center with his two oldest sons. On the left is his oldest son, Joseph Kennedy Jr., who was a fighter pilot in World War II and lost his life in the line of duty. On his right is John F. Kennedy. During 1929, Joseph Kennedy was in New York City, I suppose because of his background, that he was probably down in the financial district, down close to Wall Street, and he goes by this shoeshine boy to get his shoes shined. And while he's there, the shoeshine boy is giving him stock tips. I don't know if he knew who Joseph Kennedy was at the time, but he's giving him stock tips because the people in New York, particularly down in the financial district, they were coming by to get their shoes shined, and they were talking stocks, this one and this one and this one. And this young man was listening to all of this, so he was pronouncing what he thought were good stock tips and so forth. So Kennedy heard this, paid the boy, and left. And as he left, he recounts the thoughts that went through his mind. He remembered thinking this thought and wrote it down, and it has been quoted quite a bit ever since. When the shoeshine boy gives you stock tips, it's time to get out of the market. You see, Joseph Kennedy, even at that time, this is before he made most of his money, but at that time he was worth about $3 million. In today's dollars, that's about $60 million. That's a lot of money. But he was not mega wealthy yet. But he took that, let's call it $60 million in today's dollars. So after having this thought that something's wrong with this picture when the shoeshine boy is giving you stock tips, he literally went back to his office, and I'm assuming he called his stockbroker, which is the way you did it back then, and said, sell everything I've got. Not too dissimilar from the story of my friend Bill. However, the second part of the conversation was even more dramatic. He said, and I want to short the stock market. Now, I can't find information. It wouldn't mean anything to me if I did, but I can't find information about what stocks he shorted. It's not important. Maybe it was the same stocks, but he shorted the market. And I'm assuming he took all 3 million or 60 million, however you want to view it, and took all of that money and shorted the market. That was the way I've read the story. What that means is that if the stock market, those stocks, go up in value, you lose money. You only make money if they go down. It is reported that in 1935, so this would be 6 years later, his 3 million was worth about 180 million. In today's dollars, that's over 3 billion. Now, he probably took some of that money along the way, and he entered some other businesses and made some money at those businesses. But because he had money, in a period like that, he was able to make money. So here are these two stories. They're kind of similar, and that's the reason I'm retelling this. They're similar because it tells the story that the people, let's just say the stockbroker for Bill, was not helpful to Bill. That's the equivalent of a financial advisor today. They don't call themselves stockbrokers, they call themselves financial advisors. And Joseph Kennedy, stockbroker, probably same thing. They were more than willing to take people's money and put it in the market, and it did not appear that they were calling anybody and saying, get out of the market. So the industry is oriented to taking your money and let you buy it. It's called buy and hold. You buy it and buy it and buy it. No matter how far it goes up, you buy it. And no matter how far it falls to the bottom, you stay with it. I've had so many calls from people who have said to me that their financial advisor refuses to take the approach of selling anything. Just let it fall. It'll come back. You've got to invest for the long run. You can't sell now, etc. This frustrates people because they see that they've lost money. They want some kind of methodology. If the stockbroker or financial advisor were to say, I just recommend you do this. Why don't you just let's take half of the money and put it aside. Something. They're looking for some kind of methodology that says the person who's taking the fees from them is actually thinking about their best interest and doing something for them. It doesn't have to be the best. It doesn't have to protect all the money. People are just, from people I've talked to, they're looking for somebody who will do something. And that the industry is not oriented to that. I wanted to show you a chart. I've shown this before also, but this makes a point that's a couple of points here that I think are very important. This is a chart that this covers the Great Depression. So this primarily covers 1929 to 1939, and you see the yellow line across the bottom, that spans, is the Great Depression. The black line that goes through the chart is the Dow Jones Industrial Average. Now, people back then, there were no exchange-traded funds or mutual funds or ways to buy the Dow Jones Industrial Average. You couldn't do it. Back then, the only thing you could do is buy stocks. Now, you could short those stocks, you could leverage those stocks, but there were no ETFs and no mutual funds, no index funds. But this is a chart of the Dow Industrial Average, and we can use it as a benchmark. From its top, I drew an arrow, a black arrow, from its top to its bottom. That is a drop of 89%. Nearly everybody that had money in the market, and a lot of people did, it drew in a lot of the average people that normally before had never invested, lost everything, lost it all. However, just looking at this, if you were typical and stayed with it all the way to the end, you lost 89 cents on the dollar. And at the end, you had 11 cents on the dollar. I imagine there were very few that did that, but those who stayed with it, somewhere along the way, they lost everything. And then you see the yellow boxes, and those are some political activities that occurred along the way. I wanted to show you this because when there are two parts to investing. One part is, as I've described, whatever method you use, protecting as much as you can downside risk. I think that is job number one. But the second part is not just to do that, because I don't know how many people could do it, but I think a lot of people could do it. But then the problem is that the market goes down so far. It may not go down 89%, but it may go down 20 or 30 or 40%. And at some point it stops going down and buyers come into the market and the market goes back up for some reason. The economy may still be bad, but the money is not made. I mean, I'm not thinking like Joseph Kennedy because I don't short the market. I think that's, in my opinion, too risky. But if I'm trying to get out of the way of the market, I'm not going to do that perfectly. So I will experience some losses and I will accept small losses. However, I don't make money doing that. So people want to make money eventually. In a falling market, the way I do it is I go to cash. That's not a way to make money. That's a way to protect money, but to not make money. So eventually, the market will go down far enough and then it will rise. What I do is what I want to do is to re-enter the market as soon as possible and make money when it rises. I don't know how far it's going to go up, but I want to ride it as much as it does. So when you look at the bottom, on the bottom, there's three, center of the chart, there's three red arrows. The one on the left, because it's a numerical chart, it doesn't look dramatic here, but that little red arrow, that is a rise of 82%. The Dow went down to 41. It rose to 75 at the top of that arrow. Going from 41 to 75 is an 82% increase in value. That happened in 2 months. And then it turned around and lost about half of that value. Then it went up 100%, and it took 5 months. Can you imagine that? In 5 months, the market went up 100%. It doubled. That's unheard of today. And then finally, to the right, the third arrow, the market for 2 years went up another 100%. Between the second and third arrow, the market approximately went sideways. But that third arrow went up 100%. So 3 times, 82%, 100%, 100%. If a person is operating like Joseph Kennedy, let's say, or like my friend Bill, and a person is operating on emotion, and we're all emotional beings. So if a person is operating on emotion, their emotions at the further the market falls, whether they're in the market or not in the market, if they're in the market, they're exhausted. They're beat up emotionally. If they're out of the market, they're feeling validated. So, but emotions come into play a lot. And so do you think you or any person or me is going to have the emotions and the financial ability to re-enter the market at the bottom? Are you going to have the money and the emotions to do it? Most people don't. And then the second time and the third time, that's where the money is made. And the way I see it, I'm using this as an example. It's a great example because it illustrates the point that the way to make money in the market, I believe, the best way to make money in the market and minimize losses in the market is tactically, is to not do buy and hold, not do 60-40 portfolio, as people suggest. And I know that the vast majority follow that approach, but the vast majority also of advisors, everybody I talked to dealt with advisors, with the exception of one person, dealt with advisors who did nothing and let the market collapse and were more than willing to collect a fee for that. That just doesn't make sense to me. So to me, it seems like tactical investing is the smartest way to do it. I started that back years ago, but in this kind of market, or in 1929 to 1939, another good example of seeing that there are times where the market collapses so much, loses so much value, that you definitely want to be out of the way. And then at the bottom, 1932, this is the heart of the Depression, a gain of 82%. 1933, a gain of 100%. That 32-33 time period was the worst time period in the market. And then from 35 to 37, also heart of the Depression, another 100%. So it's hard to go by your feelings. It's hard to go by the news on TV. It's hard to go by the economy. If you looked at the economy, the things were terrible. There were just millions and millions, tens of millions of people out of work, and yet the market is going up. So it didn't make sense. If they had TVs back then, which they didn't, people would have said, there's no way I want to get in the market. But yet opportunities came along. Now I want to play a video for you. This is a PBS documentary, and I thought it was interesting because it helps make this point. They aired it some time ago, and then they re-aired it last year. And it describes a bull market, what goes on, the emotions that go on with that, and how everybody is making money and everybody is happy. And they don't have to be smart. They don't have to even know what they're doing. They just make money. And people actually start to think they are smart. They have this feeling like Bill had twice in that story, you can't miss. Then the other side of the market happens. Now, they did not in this documentary cover the Great Depression. They covered 2000, 2008. But if we went back to 73, 74, 79 to 82, and the bond market in 1994, there are other periods where there are severe losses that occur in the market, and people are caught off guard. They're not prepared for them. Today, people may think they may be lulled to sleep with their portfolios having gone up and up and up and up. It's just kind of on autopilot. Oh, this is not going to happen again. This can't happen again. This time is different. And then it's not. Then 2022 happens. And by the way, 2022, the S&P lost 22% in mid-June. The NASDAQ lost about 30%. From what I'm reading, from the experts, I read this morning, Jeremy Grantham said that he expects another 25 to 30% drop in the stock market. And he didn't put a date on it, but he said we're not at the bottom. And I would put, because of his track record of calling bear markets correctly in the past. I would put a lot of weight on what Jeremy Grantham said. I'm not saying it's this year, but I would say this. It does not feel like we're at the bottom and are now on the way back up. It feels like when the market goes up for a short period of time, having fallen as far as it has, with the outlook as the way it is in the economy, that the market is still on a downward trajectory, and caution and a method to protect one's money is called for. So I'll play this, a few minutes of this clip from this documentary.
Start saving $300 a month when you're 23, and you could retire a millionaire.
The boom happened in lockstep with the roaring bull market of the 80s and 90s. Mutual funds were charging high management fees, but nobody seemed to care.
The returns are great. So no one thinks about how much is this costing me when they're earning 15 or 20%.
Star mutual fund managers like Fidelity Magellan's Peter Lynch encouraged all of us to jump in.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it.
Saving for retirement seemed as simple as betting on the market.
It was a great time. Employees who participated in these plans and invested in the stock market, couldn't wait to open their monthly statements to see how much the value had gone up, So things seemed to be working nicely.
Well, I was invested in everything. Stocks, mutual funds, you name it. We would get monthly reports. Things were growing. Everything was growing. In the 90s, you could not lose money in the market, even if you were a dumb investor. I mean, it just kept growing and growing and growing.
Internet stocks drove a powerful surge on Wall Street today.
Internet stocks, suddenly...
The economy was doing great. I mean, you had all kinds of gains in the stock market. That was kind of the dot-com era.
Those internet stocks continue their meteoric rise.
You really didn't have to pay attention to, you got your statements at the end of every quarter and you were making money.
It was exciting because gradually over time, we would have a day where we would make $7,000 or and as much as $30,000 in a day as it built, and even more.
In 1996, we had doubled our money. We had almost 500,000.
Steve Shulo and Dan Robertson believed they were headed for early retirement the day their portfolio topped $1 million. It was November 11th, 1999.
Oh, that was a very nice day that day, wasn't it?
What happened November 11th?
See, it's when our portfolio went over $1 million. So
Oh.
That was just amazing. It was like, well, yeah, this is how investments work. You invest it and it grows. I mean, that's how I thought about it.
It was a manic Monday in the financial market.
Stocks plunged. Traders are standing there watching in amazement, and I don't blame them.
But in the spring of 2000, the market collapsed.
Say a lot of their customers are freaked out.
We did not know. This is our mistake. We didn't know it was a bubble. We just didn't know. Our portfolio had gone all the way down to where it was in 1996, from 1.5 million to 500,000.
460, I think.
All that was gone.
At the height of the internet bubble, Americans had also stuffed 19% of their retirement money into company stock.
We invest all of our 401k in Enron stock, absolutely. Don't you guys agree?
For savers like Debbie Skaczynski, who worked for ComDisco, a computer leasing company, the fall would be precipitous.
I was close to $500,000 I had in my 401k with company stock. It was like, wow, look at all the money we have. Look at what is happening. I can retire probably when I'm 45.
The dot-com failures continue to mount.
Skaczynski not only lost her savings, she lost her job.
Cisco today filed for Chapter 11 bankruptcy protection, including another 200 job cuts.
Joined a who's who list of corporate bankruptcies for 2000.
The day I got laid off, I lost it. I thought, oh my God, I'm a single parent. I have no job. I have a house payment. What do I do? And I was scared, really scared. I didn't have much of a retirement left. I couldn't even borrow against it. And it was just something that I never foresaw, ever. Losing my job, ever. Never.
The worst was yet to come.
Concerns about shaky home mortgages are triggering fears of a financial meltdown.
Talk about the speed with which we are watching.
8 years later, savers were hit again.
Turmoil in the mortgage market is far from over.
This is volatility we haven't seen, of course, since way before you and I were born.
More trouble ahead for the nation.
When the housing bubble turned into the crash of 2008, it put retirement even further out of reach.
Economic turmoil of recent years is putting a comfortable retirement at risk for many Americans.
It was like, holy smokes, how do you stop the bleeding?
The reality of what you've lost is huge. Right. I mean, not only have you now lost half of your 401k, but your house is not worth anything anymore either. So anything that you thought you were going to have there is gone, and now half of your 401k is gone.
If it took 13 years to accumulate $80,000 and 1 year to lose half of that, and then try to get that back in another 13 years and only be at the $80,000 that you were 13 years ago, the math doesn't work.
Debbie Skoczynski was already in a hole with next to nothing to cushion the blow of a second shock. And now her house was worth less than the loan she owed the bank.
There's some days where it's like, you just want to go scream, in the backyard and just scream because you have your choice. Do you pay this or do you pay this?
Her bills were piling up. She did what a quarter of Americans have done. She dipped into what was left of her 401k.
I freaked out when I took the money out of my 401k. It was hard. I mean, it's, every day on the news, I'd listen to it and I'd be like, oh God, it's really bad. Will I be able to keep my house? Well, what if my car breaks down? I can't afford a car payment. It just can't be this hard to make money. I can't. You hear these big companies with these people taking these huge bonuses. You're thinking, well, what happened to the average Joe? They just don't care. They've made their money already.
Okay, now I want to switch gears and go over to the flow of funds report. Now this is interesting to me. I'm going to show you a few pieces of data and charts that say something interesting to me. Last week, the market had gone down and down and down. Mid-June, it hit a low point, went back up, and then up until last week, or a week or so ago, it hit not all the way back down, but it came back down quite a ways. The last week, it went up for 3 days. Really nice gains the last week. And so some people, it's drawing the small retail investor into the market. But what's interesting, last week, the flow of funds report, the market went up 4% last week, the last 3 days of last week. The flow of funds report said equity funds had net outflows of $8.7 billion. Now that's not a lot of money for the entire market, but money was going out of the market, not coming into the market. The market goes up on supply and demand. So more people want to buy it, then want to sell it, it'll go up. But yet $8 billion came out of the market. Bonds, $9.9 billion came out of the market. Money market flows, you think, well, the money is going into money market. The net outflows of the money market funds was $3.2 billion. And like I said last week, where did the money go? We don't know. I could speculate, but I don't know. But I'm telling you, that is not the sign of the beginning of a bull market. We're still in a bear market, or that report would not be what it is. Okay, indicators. So you can see this is as of Friday, we we had nothing but red dots on the right side a week ago. So now we have 7 green dots, and the rest are red. So the year to date, you can see the best picture is the Dow Industrial is the top one, down 11%, S&P 500 down 14, Russell 2000 down 15, emerging markets down 20, and developed markets down 20, and then NASDAQ 100 down 22, and then the worst, here we go again, 20-year government long-term bonds, ETF, TLT, down 26%. Worse than all the stock indexes. So you can see from the weekly, the second row of numbers, the first row is the percentage change for that day, Friday, and the week. But as it gets to the month and quarter and year to date, the numbers are still negative. When we take the S&P 500 and break it down into the 11 sectors of the S&P, you can see what those 11 sectors look like. Some are all negative. One, energy, is all positive. It has been all year. And some of the others are either have gone above their 20, 50, 100-day moving averages, and only energy is above its 200-day moving average. So a lot of negative numbers throughout all of the sectors, going from the best one on top all the way down to the worst. Now I chart the S&P 500, the Exchange Traded Fund SPY, SPY, and this is a weekly chart, a 12-month weekly chart, showing one move equals 1 week spread over a 12-month period of time. So 52 moves up or down. The black arrow indicates a trend. The trend for the S&P 500 is down. And as of Friday, it was below its 20-period moving average. However, at the end, you can see for the last week, that 4% move of the last 3 days influenced the move for the S&P 500 in an upward direction, and you see that on the far right of the chart. And then you can see the moving average going through those. The growth stocks in relation to the value stocks in the S&P 500 are expressed as an equation, a ratio, and so I plot that ratio. Growth is the numerator, value is denominator. And then I put a 20-period moving average on it, and this again is a 12-month chart. So you can see that the general direction is down, and what that means is that generally speaking, value stocks are in favor, and growth stocks are more out of favor. Although last week you can see that little tick up, growth started to come back into favor slightly. But the general direction is down. I expand this from a 12-month chart out to a 24-month chart. And I chart it because I want to show you this relationship. So I chart numerator against a ratio chart. I'm charting the ratio of the small cap Russell 2000 index, IWM, as a numerator, and SPY, the large cap, largest 500 companies on the stock exchange. So small cap divided by large cap. So if it's going down, that means a large cap is in favor. If it's going up, that means small cap is in favor. I didn't put an arrow on it, but you can see the first, 7 months? 7 months of the chart, small cap was incredibly in favor, outperforming the S&P 500. And then it didn't. And then it went down, and the small cap is out of favor, and the large cap is in favor relative to each other. They may both be going down, which they are, but the small cap is going down greater than the large cap. Now take a 30-month chart, because I want to show this over, make my point here. This is back to the long-term government bonds, TLT, and I express this over 2 periods of time where you can see trends. And you can see that on the left, the first black arrow going down, that bonds are starting to collapse. And then they make a head fake and try to go back up for 10 or 11 months. But they're not going to last. And this shows that bonds are in a bear market, and even though they had a gain period for 10 or 11 months, that was not the beginning of a new bull market for bonds. They collapsed again, and the arrow on the right shows the level of acceleration and trajectory of the long-term government bond, and it's going down and down at a faster and faster rate. This is part of our bonds like this. Short-term, intermediate-term, long-term, they all move in a similar direction. It's just a question of magnitude. Or corporate bonds or high-yield bonds, all going in a downward direction. Why? Interest rates are going up and bond yields are going up. Very simple. But this is part of portfolios. It's part of target date portfolios and 401k plans, 403b plans. And in my opinion, it spells trouble. I've been saying this for a long time, and it keeps on spelling trouble. So there are other ways to lower risk. Putting this together with stocks does not seem like one of them to me. Okay, gold has this is a 48-month chart. So over half of this, over 2 years of this, gold, represented by the ETF GLD, is generally goes up and down a lot, but generally speaking has been in a downward trend for over 2 years and is below its 20-period moving average. Silver, I shortened it just because you see the magnitude of this. Over the last 18 months, silver has been going down, although it had a good week last week. It's still, generally speaking, in a downward direction. When I chart silver, SLV is the ETF, as the numerator, GLD, gold, as the denominator, you can see that, generally speaking, that ratio favors gold. If it's going down, silver is out of favor and gold is in favor. They may both be going down, which I showed you, but generally speaking, but gold is going down less. And that's the degree to which it is going down less. Volatility Index. The Volatility Index measures market volatility. And so if the market goes up, this tends to go down and vice versa. So this is just a 12-month chart. You can see the far right of the chart, you can see that the index went down last week, and I put a black line at 24, which is my indicator for higher risk and lower risk. So now it is 2279, definitely below the below 24. So volatility has tended to come out of the market in the short run. Now, this is the other thing I was going to mention, is that it was curious to me that a lot of the charts or the data that I showed earlier, the dashboard, that they didn't seem to indicate that, and the flow of funds report did not seem to indicate that the market is going up. So at the end of Friday, Asbury Research does their indicators, and after Friday's data, 3 days, and the market went up 4%. The S&P 500 went up 4% in 3 days. That's quite a bit for 3 days. After those 3 days, how many of their indicators were positive? 1. That is not the beginning of a bull market. I'm just saying. It felt good to see that gain in the market, but in my opinion, this data supports it. It's a head fake. The market is probably going to be going back down. The question is when. We don't know when. So I'm not making that prediction. I'm just saying that these 6 indicators, if you've been watching this broadcast, you've seen they're pretty accurate. They tend to read really what's going on in the market, and they're fundamental indicators, and only one of them is positive after that. I thought that was very interesting. Then this is the cross-asset relative performance. Which areas are better than others? So I look at all 3. There'd be the weekly, the monthly, and the quarterly, and a lot of them are favoring the alternative. So stocks are doing better than bonds. We definitely saw that in all 3 categories. Even though they're down, generally speaking, they're down less than bonds. High volatility stocks are outperforming low volatility stocks. S&P 500 is outperforming the Dow in all 3 categories. And then the U.S. is definitely outperforming the emerging markets, and in 2 of the cases, outperforming the developed markets. High yield is outperforming the corporate bonds, the low quality outperforming high quality, and short-term over long-term bonds, short-term is outperforming. No surprise, in a down market, short-term is going to outperform, and if they're going up, it would be the reverse. The U.S. versus the world. What's interesting is no matter what happened, even last week in the U.S. market, it was not enough to put the U.S. in a green box ahead of all of these countries and regions of the world. It's interesting. And when we look at the monthly and the quarterly, same thing. The most dominant countries are New Zealand and Brazil. Advisor Perspectives publication looks at the Buffett Indicator. I'm going to show it to you next. But this gives you a snapshot, kind of a dashboard to say what's going on mathematically with it, and then I'll show you chart-wise. This shows, as you can see in the top box, that they consider, based on the valuation of the market today, even though some air has come out of the balloon, that equities are overvalued. You've seen that the S&P 500 is down 14%, the NASDAQ is down 22%, and they are overvalued, meaning they're too expensive. Why is that? Well, when you take the Buffett Indicator, it's the market value, the stock market, the value of equities, divided by the economy, gross domestic product. Very simple. Stocks divided by the economy. That ratio is 175%. When, generally speaking, when that is above 100%, that is trouble. But at 175%, that's trouble. Now, this is not the stock market per se, it's just the stock market divided by the economy that should be supporting the stock market. Here is the chart of that showing where it currently is. So if you go to the right side of the charts, the blue line, this is plotting the ratio of stocks divided by the economy. Stock market divided by the economy. So it has gone up. It has gone so high. Now this is a 70-year chart going back to 1950, 72 years. You can see how high it got. And then the last couple of quarters, it pulled back, and you can see it pulled back nicely. But you still see, and there's an exponential regression line, the red line going through it, you can still see how elevated it is relative to the exponential regression line. Still pretty high. And look at the amount of time that how far it goes down. When it falls, it doesn't just go down to the red line. It goes usually below the red line. It always overshoots to the bottom, and it overshoots on the way up. So, yeah, it's still overvalued, and even though it has come down some. Last week was a good week for gold and silver, especially silver. Gold went up 0.5%. Silver went up 4.5% from the previous week. So I talked about the Joseph Kennedy story, the Shoeshine boy, and I just want to say for you to think about what indicators you use. What indicators you use to protect your money. Don't count on your financial advisor to do it. They're not doing it. And what indicators do you use? This is a pretty unsophisticated indicator, isn't it? But it was better than nothing. And it was certainly better than the stockbroker was giving him. So you may have to be your run defense for yourself, because don't count on the professionals to do it for you. That has not worked. Every person I've talked to, except one, has told me that they have been left in the dark. They have been kind of abandoned as far as protecting their portfolios. And as we look forward, I think there's continues to be a lot of risk in the market. And looking forward, how are you going to look after yourself? Thank you for watching. If you have questions or comments, leave them in the comment section below, and I will try to respond to them. Thank you for watching.